Hi friends, namaskar. Welcome all of you to my channel. Today let's discuss about the some of the selected problems which I have prepared for the course entitled Analysis of Accounting Informations, like periodic inventory system, inventory error, and estimation of inventory. At the same time, how we find the inventory conversion period, and particularly how we interpret the results. That's very important. So I believe that today's discussion would be important for all of you when you are studying a financial accounting course, and even though you are not studying financial accounting course, but still you would like to know about the how we are going to interpret the inventory parts. So today discussion would be important for all of you friends. Now let's talk about the given information we have. That's we have a data purchase units, unit cost, and once we multiply this units into rate, you would have a cost information, total cost. Okay, so that means is available for sale, that's units available for sale, is nothing that is opening inventory plus all purchase data friends. Okay, so the question is about, and since you are given the ending inventory, that's a 150 units, so you are asked to find the ending inventory cost of goods sold using the FIFO, LIFO, and weighted average cost. So first in first out, last in first out, and weighted average cost method. So at the same time, you are asked to, if the tax rate is 30%, corporate tax rate, then what would be the tax saving due to use of LIFO methods? So at first, remember, when you are estimating the ending inventory by using FIFO, then we should take the reference of most recent purchase date, friends. Okay, most recent purchase date is our November 30, and since our ending inventory is here 150, friends. So that means 100 is this one. So next most recent date is September 19. So you could take 50. So you could see here that is November 30 is the 100, while September 19 is 50 units. Since our ending inventory units is just 150, you are going to estimate that ending inventory. So we can use this is like 100 into 6, and the next 50 into 5. So accordingly you would have a 850 is our ending inventory. Now what about the cost of goods sold? So cost of goods sold means that is the cost of goods available for sale minus ending in inventory value. So cost of goods available for sale is that this is the once you add it beginning inventory plus all purchase. So this value is nothing, this is our cost of goods available for sale, that is a 2000, and once you exclude the ending inventory value, that will provide the cost of goods sold under FIFO approach. But regarding the LIFO approach, friends, we have to take the reference of earliest date, while FIFO we say most recent date. Okay, so now you are going to find the ending inventory value using the LIFO approach. Okay, so under LIFO, remember, so our earliest date is January 1st. So is the 100 units into 2, and then next date is our March 27. So we could use here the 50 into 3, since our ending inventory units is 150, and that is why you could value it, and 350 is our value of ending inventory, and accordingly cost of goods sold, and since our cost of goods available for sale is 2000 and we just estimated 350, so accordingly we can say that cost of goods sold is that under LIFO approach 1650. Now what about the weighted average cost method, under which we simply you need to understand you have to find the average cost, unit cost, or we can say that average unit cost, or sometimes we say that weighted average price method. So simple, you have to understand this one, how we find the average unit cost. So cost of goods available for sale divided by units available for sale, and since our cost of goods available for sale for whole method is that, so given information is 2000, while units is 5000, this 500. Okay, so we can say that our unit cost is rupees 4 per unit, and since our ending inventory is 150, so ending inventory units into this rate is known as, you can say that, okay, this is the cost of goods available for sale. Then yeah, this is our for 600. You can say that is our simply what do we do here? We say that our rate is 4, and once you multiply with the ending inventory, so you would have a 600 rupees. Okay. Now the question is about when the tax rate, corporate tax rate is 30%, what would be the amount of tax saved due to use of LIFO approach? Remember, when we have an inflationary situation in an economy, so in that case, LIFO method would provide highest cost of goods sold. Yeah, you can say that higher cost of goods sold as compared to LIFO FIFO approach. So LIFO cost of goods sold is our 1650. We have just calculated here 1650, while under FIFO we have a what a value? Under FIFO we have estimated is the 1150. So we can say that excess expenses because of use of LIFO is that LIFO approach is 500, friends. Okay, so it's a 500, and if the tax rate is 30%, so 30% of this value is how much? Is the 150. So tax saving, or you can say that because of use of LIFO approach, which provide the highest, you can say that cost of goods sold, you would have a tax saving of 150. Okay, this is about the concept of periodic inventory system. Now let's talk about what about the inventory error, friends. In the notes you could find it in page number 12. Okay, anyway, this is the given information. You are given the like a particulars, net sales, cost of goods sold, gross profit, operating expenses, and last outcome is that net profit. This is the 2001, 2002, 2003. Now the question is about the accountant recently discovered that the 2001 ending inventory was understated by 5,000. Remember, that means we know that the cost of goods sold is simply the framework under which we say that opening inventory plus net purchase, which is called cost of goods available for sale, minus ending inventory. That means once we say that we deduct less as ending inventory while finding the cost of goods sold, in that case this is the part you can say that because of this error, this cost of goods sold was overstated. Once we say that we understated ending inventory, cost of goods sold would be overstated because you have deducted less. So in this case, what you have to do here, for again you are going to prepare the correct income statement of this company, like a Sapna company. Okay, so net sales is the same, but cost of goods sold would be, since I discussed earlier, friends, that is the because of understated ending inventory, cost of goods sold would be overstated. So now it has been overstated, so you are going to correct it. So correct value would be simply 49,000 minus 5,000. This is 44,000. So this is gross profit. So net profit would be, this is the correct value is the 50. That's a 20,000. Now what about the case of 2002? Remember, ending inventory in the 2001 would be the beginning in the 2002, in the next year, I mean to say that. So in that case it will be just the reverse case, because we previously we say that opening inventory plus purchase less ending in inventory, but now this ending inventory would be the beginning. So that is why you have to what you have to do it. Previously we have this is deducted. Now simply we have to do is 51,000 plus 5,000. So this will be 56,000. So this is 15,000 is our value. And remember, we don't have any effect in the 2003. So simply we all copy and we just rewrite here the same thing. So that means whatever we calculated, you have to understand and analyze the information. So understated ending inventory of the 5,000 causes overstated cost of goods sold and understated the net income. Previously it was 15,000, but now when you are correcting it, it will be just corrected by over 5,000, friends. Okay, and it results understated in the cost of goods sold and overstated in the 2002 is net income. This way we could interpret the information. Now let's talk about what about the estimation of ending inventory, friends. Basically we have a two approach, remember. One is the gross profit and next one is that retail approach. So this question is about particularly gross profit approach. So this is the case of we have a beginning inventory, purchase return, freight in, sales return, and estimated gross profit is here. So remember, so we have a beginning inventory is 15,500, purchase is 5,500. So we have to find the net purchase value minus purchase return 150. So this will be the net purchase. But when we are purchasing, we have to bear the certain transportation charges might be there. So that is called freight in 150 and sales 10,500. Once you exclude the sales return, so net sales would be now 10,000. So when you are preparing this, you are going to find this ending inventory. So in this case, as I explained earlier, is the ending beginning inventory, net purchase. Net purchase means that is this is the case. Purchase, return and allowances. So this is the value. Freight in 150. So this is called cost of goods sold, friends. Okay. So that means beginning inventory plus cost of goods available for sale is known as cost of beginning inventory plus cost of goods purchase is known as this is the cost of goods available for sale. And while once you exclude the deduct the cost of goods sold, which is the simply if the net sales is 10,500 minus 5,000 is the 36%. That means simply net profit minus gross profit is 6,400. You can use it. This is the cost of goods sold. Yeah, you can say that is the simply 64% of net sales value is the cost of goods sold. Directly you can do it. So our estimated ending inventory now is the friends 14,600. Now let's talk about what about the case of inventory turnover ratio. Yeah, inventory turnover analysis part. So that means when we have a good increment in the inventory turnover ratio, this is the good signal for the company. Like in this case, we have a data of one is the Walmart and the next one is the Target. So inventory 2024 and we have a inventory 2025. So you need to find the average inventory when you are given the beginning inventory and the that's the you can say the beginning inventory and the closing inventory. So in this case you are given even the cost of goods sold. Okay. So the question is about what would be your inventory turnover ratio. So for 2025, so simply we can say that cost of goods sold divided by average inventory. So in this case, you can use this is now I have used the 2025. So in this case, you would have a how much? Cost of goods sold 2025 data, then divided by average inventory. So this will provide you the information. So accordingly, you could find for the both companies, friends. Okay. Now, lastly, now let's just discuss about so days in inventory or inventory conversion period. This is simply we can say that the market is so competitive, friends. We have to supply the goods ordered by the consumer before the competitors. So our target is to how fast we convert the raw materials into finished goods. So that term is known as simply days in inventory. Simply we can find it number of days in a year divided by inventory turnover ratio, friends. Okay, for both companies you could find it. So ICP is one of the important component of cash conversion cycle. Yeah, cash conversion cycle means is like inventory conversion period, receivable collection period plus minus we deduct the payable deferral period. The point is that if ICP is low, so it shows that we have a better inventory management and we can meet the customer demand on time, friends. Okay, friends, I believe that today's discussion is really long. Despite that, it would summarize the overall concept of inventory analysis, friends. So you could take the reference of any financial accounting book like your Narayan Swami. Similarly, that's a financial accounting managerial perspective, Norton Porter, and other books too, friends. Okay friends, if you have any suggestions, comments, please let me know also, so that I could offer you the good uh, conceptual understanding, and you could at least understand the basics, friends. Okay friends, these are the things that I would like to share today. If you like this content, please like, subscribe, and also share this channel. Thank you all of you for watching this video. Please take care all of you. Thank you.